Gentlemen, good morning to you both. Brendan, I'll start with you. The fact that we have seen transports sell off in recent weeks, a lot of it led by many of the freight names amid concerns about the rollover we're seeing in freight rates, particularly in certain segments of trucking. Contextualize that for us.
Yeah, Morgan, good morning, and thanks for having us on. And look, the pullback in transports relative to the market here in the last month has been over 15%. We've only counted that type of relative underperformance maybe 3 times in the last 30 years. So definitely something to pay attention to. Look, everyone remembers Omicron a couple months ago. Labor availability went down across the supply chain. That's why trucking rates actually peaked back in December. We've now come about 25% off of those peak trucking rates. So a lot of pundits and media folks have said, wow, trucking rates are coming down. That means it's going to be a bloodbath for transports. But in reality, it just means that some of these supply chain constraint issues that we were seeing when we had to ration capacity are actually coming off. So we're getting goods and services now, flowing through the economy, which we think is a very good thing. And not all the transport data is negative. If you look at rail volume, it's actually sequentially accelerated through the first quarter. We think that turns positive for the first time in about 12 months here in 2Q. And historically, when rail volume's up, transports actually tend to outperform. So we're actually very aggressive buyers of this pullback right now.
Okay, I do want to get into that a little bit further. But Stephen, first, your take on what we're seeing with the passenger airlines, especially given the fact that it's been a busy week in terms of M&A news.
Sure, absolutely. Good morning, everybody, and hello, Brandon. Certainly, when we look at the passenger airline side, when we look at the last 2.5 years, we've been in one heck of a demand shock. It seems we're now kind of coming out of that demand shock. If one looks at daily TSA throughput, we're now just 10-some-odd% below pre-pandemic levels. And from a pricing perspective, what we've seen in our recent work is April and May domestic booking curve. You have fares up 8 to 10% versus pre-pandemic levels. And in spite of that increase, with May actually strengthening versus April, we have not seen any meaningful pullback from a volume perspective. So elasticity concerns have been, I think, front of mind for some investors. That's definitely not what we're seeing. So we are coming out of the demand shock, certainly in a choppy market at the moment, given some geopolitical events. But longer term basis, it looks like a reasonably good setup, especially for those carriers that have de-risked their earnings streams.
Okay. So, Brandon, what would you be buying right now?
I mean, J.B. Hunt, I think, has pulled back about 15 to 20% here in like maybe 6 or 7 trading days. And for those that don't know, this is a company based out of Arkansas, but they do a lot of intermodal movements. So this is moving, highway trucking freight over the rails, where you get a labor cost and a fuel cost advantage. So it's ESG friendly. The rail system has been hit by all these successive COVID waves and all the supply chain constraints we're thinking about. So as 2022 progresses and we see these things smooth out and get back to normal, we actually think J.B. Hunt's going to see a lot of volume expansion in the back half of the year.